Hello traders, welcome. We are looking at something that is very important in trading, which is change in state of delivery. Change in state of delivery is something every trader needs to know and need to master when it happens, when it occurs, because it is something that is often used in trading. You use it in your entry and you use it to detect the price move. So what is change state of delivery? Change state of delivery is simply a market shift in momentum. As we know, in an uptrend market, the market does not always trend, it changes direction. The market moves from uptrend into downtrend. The market also moves from downtrend to uptrend. It moves from uptrend to consolidation. The same thing on a downtrend. So that shift, that moment the market is shifting direction is what we refer to as change in state of delivery. It means the market is changing momentum from being bullish to being bearish, or from being bearish to bullish, or from bullish to consolidation. So how can we detect this change instead of delivery and use it in detecting the next direction of the trend to be on? So let's take a look at this diagram here to illustrate how we can use this change of delivery in our trade and how we can identify these zones in our trade. From this price action here, we can see that the market is printing bullish. We see the market making higher highs here and higher lows. So we can say we are in an uptrend from here. We can see a break of structure here. The market broke structure to the upside. As we can see here, when this structure was broken, we have a long bullish candle with momentum, which created a fair value gap here, and we have another candle close above this bullish candle. So when this thing happens, let's say probably the market went to hit a long time frame PD array here. This candle, this last candle becomes our last valid bullish candle. Why is it a valid bullish candle? Because this candle here closes above the high of this candle. So the market is still telling us that it is still bullish. When the next candle appears and we have this candle dipped into this fair value gap here and fell to close above this candle. So in this scenario, this candle you are seeing here, which the low is here, it remains our last valid bullish candle. So assuming this candle closes above this high, we will still be looking for this price to continue. So this candle comes around this zone here. It took this low here, but it went up to close inside this candle range. This is what we normally call a liquidity sweep. Price came down and swooped this candle low here and dip into this fair value gap here, into this imbalance here, and move on to close within this candle range. So when the next candle appears, we see a long bearish candle. This long bearish candle closes below this valid bullish candle. This long bearish candle, which is an engulfing bar, it signifies a valid pullback. So when this candle closes here, I printed another bearish candle which closes beyond that range. So what happens here is that we have a fair value gap here that we are waiting to see whether this fair value gap or this price. This fair value gap would have been valid if we have seen this candle displaces and take this high here, but we still have this candle close inside this candle range, meaning that this fair value gap is still active. But when this candle came, these two candle appears, they close below this fair value gap with momentum. They disrespected this fair value gap here. When they disrespected this bullish fair value gap here, it signals a possible reversal. We can see the closure of this candle here. When this bearish candle closes here, we will anticipate to take our entry position from this area. Then we see this candle returns inside this fair value gap and retested this fair value gap. This area now becomes our inverse fair value gap. When this area becomes our inverse fair value gap, we will wait to take our entry in the next closure of this candle. So I don't normally take my entry when I'm seeing candle inside this range. I normally take my entry when I'm sure that I have a closure. So you can switch to your lower time frame to find your entry from that point. So this is the first phase of change in state in delivery. We have this candle pullback and we see the trend continues from there. So after this push here, we still have this area. This area is our confirmation. This place is the last recent swing point in price. When we are expecting this move to come and break this range, and if we break this range, we will now confirm that we are entering in another phase of another trend, which means our trend is now bearish. So this is the second phase of momentum shift confirmation. Like I said, price came down. We need to wait for a valid pullback that will close below the last valid candle, whether bearish or bullish. When it closes, and from there, another confirmation will be for that price to come and take our last recent swing point, which can be a swing low or a swing high, depending on the direction of the trend. So normally, if you are taking your entry from here, you will wait when price take this point. You will wait for a pullback into a point of interest and take that trade from there. So in this kind of scenario, if you are not so experienced in this type, so it is advisable to take this one, which is a lower risk trade. But this one will definitely give you a higher reward, but you need to wait for certain confirmations. Most importantly, you need to always look out for fair value gaps that are respected and the ones that are disrespected. Fair value gap is very, very important in spotting the direction of where price is actually going. First of all, you have to establish your draw on liquidity. When you establish that your draw on liquidity, then you will always watch for fair value gap that are respected or the ones that are disrespected on your lower time frame. When you know all these things, it will help you to be confident in that trade. That is why I normally pay attention to fair value gaps that are respected and the ones that are disrespected, and I trade on the inverse of those fair value gaps. This will help you practically to avoid a lot of bad trades. So let's hop into our chart and look how we can possibly use this change in state of delivery in order to pinpoint trades. This change in state of delivery is just on its own. You have to combine it with other confirmations to get your entry. When you just spot your change in state of delivery, it does not mean that price will continue to respect that, or the price will not come this place, come down here and go up. That is why you have to always look for further confirmations before you take your trade. There are some certain scenarios that price will come into this area and you see the price move up to this direction. In some cases, price will respect it probably before it gets to this point, or it takes this low here, because we have liquidity resting on this low. When it takes this liquidity, it will go on and possibly take this liquidity area and continue upwards. So that is why you have to wait for a lot of confirmations. Always trade in the direction of the order flow of your bigger time frame. Always trade in the direction of your draw on liquidity. That's what will give you a higher probability trade. And look for fair value gaps that are respected and the ones that are disrespected. That is what will also give you a high value trade. So let's go to the chart and see how we can use this in our trading, especially in our entry, because with this and other confirmation, we will be able to get a good entry. We are on a live chart. I want to show you an example of how you can use change state in delivery along with other confirmations to enter a trade. As you can see from this point, we see price is in a down push. We have price printed long bearish candles here. All these areas are areas of imbalance, which price is likely to go and fill up. We have our 50% areas from this level here, because before then we had a break of structure here, price push back, this is a valid pullback, then we have a break of structure to the downside before price came to this range. When price came to this point, it started making certain retracements, but price fell down and take this liquidity here. When price took liquidity from this point, this signifies a valid pullback into this range. So price is likely to push back to this zone of interest before, and we will look for a sell position from here. As you can see here, if we are looking at this point, this candle here is our last bearish candle, and we have this candle come up and take that level. When we have this candle take up this level, it is the first sign of a valid pullback. Market comes up and push to that range. We have this area that serves as our change in the direction of the trend. So this area confirms a pullback in this zone. If we are trading a counter trend, this will probably be your entry point. This is a breaker, and this is a fair value gap here. So this breaker and this fair value gap act as a confluence to enter a trade from here. But you should only counter trend when you are experienced in this. Otherwise, you shouldn't be trying it, because sometimes you will mostly get a low probability trade. Sometimes you see market, instead of going to that direction, but the market start generating liquidity, and we see price fell from this range. So that is it. You must be very, very careful when trading against the direction of the order flow of the market. I'm not saying that you shouldn't do it if you have a perfect strategy for that. I do it sometimes when I am certain of that trade. So price have come, and we have a valid change instead of delivery here, and we are expecting price to move into this range. And when price move into this range, we will be expecting to sell from this range. We have this area, this large fair value gap here. We still have another one, and we have a volume imbalance at this area. So we will likely trade from this range. This is our 50% level to 79% level. When price breaks above this range, I will be very careful in my entry. I will be looking for more of fair value gaps that are respected or disrespected if I'm going to still be in a sell position. So let's play the price and see what happens when price gets into this range. Price entered into this range. If you have taken this counter trend trade from here, would have been in a decent profit. So we will switch to our lower time frame from here to find our entry, to find our change instead of delivery. From that point, we can take our trade. This is our lower time frame. As you can see, we have many areas of liquidity here. We have dynamic trendline liquidity here. We also have low resistance liquidity that are untapped. So price is likely will come to these areas to take some of this liquidity. So let's look for a way to enter into our position. Remember what you'll be looking at. What I will be looking at is I will look at fair value gap that are respected and the ones that are disrespected. And I will also wait to see a manipulation in price to make my entry. We have two fair value gaps here. We also have our liquidity area here. We also have another liquidity area here. We have liquidity resting on all these places, all these lows here, all these lows here. We have liquidity resting there. So price will likely gravitate to this area and take all this liquidity. First of all, we have to wait to see if this fair value gap will be respected or will be disrespected. We have a high here. We have a high here. I will likely wait for this high to be manipulated. This high to be manipulated before I take my trade. I would like to see price come and manipulate this high here before I take my trade. Already we are having a kind of pullback inside this range, inside here, but I will see this price manipulate before I try to take my other entry position. So let's wait and see what price does. As we can see, price come to this point and took this area. Price come and take this high here. We have that manipulation, but are you going to enter that trade because we have that manipulation? No, we will still wait for this fair value gap to see whether this fair value gap will be disrespected. If this fair value gap is disrespected, then I can be sure that yes, this market is really changing momentum. This market is really changing momentum. You see, as you can see here, we have this fair pullback, which is the first phase in change instead of delivery, but it failed. Like I said, for the fact that you saw a change instead of delivery doesn't mean that price will go that way. This is the first phase, but it failed. Market pushback is just a pullback. This is just a pullback, an ordinary pullback, and not a change instead of delivery, not an actual one. So we have price market manipulate this high here. So let's see if market will disrespect this fair value gap. As market disrespect this fair value gap, then I will start looking for an entry within this range. As you can see here, we have price still pulls back and still take this high here. This is the market scenario playing out. You have to be patient for all your analysis to align together. That is where you will be taking your trade from. So you don't have to be in a rush in the market. There is always opportunities. There is always opportunities to trade. So you have to be patient. You have to wait to see that clear picture before you execute your entries. So I'm trying to wait for me to confirm that this trade is going my way before I make my entry. So we have another bullish candle printed here. We have another bullish candle printed here. So we will likely wait for price to come and disrespect this fair value gap before I take my entry. We have candle printed, and this is a manipulation of this candle. Though this is not a valid pullback from here, it's not a valid pullback because this is the last bullish candle here, and as you can see, this bearish candle, none of them close below this candle. All these candles are inside bar candles. They are inside bar candles, so none of them close below. We have another candle that's printed here. So this is the last. This is the last bullish one. So, but we are looking for price to come down here. Then we will likely take our trade. As you can see, markets continue to push up, and we still have fair value gaps that are printed here. We have our recent fair value gap here, this fair value gap that has been printed here. So what am I going to look for? This fair value gap. We have had this candle, this fair value gap being disrespected. You can see this candle closes below this fair value gap. So I would possibly like to see this candle close a little bit lower and see this price push back inside this candle range before I'll make my entry. As you can see, we have another candle that closes below this fair value gap. This is a valid pullback, and we have this fair value gap here, this bullish candle, this bullish fair value gap disrespected. So what I'll be waiting for is to see price push inside this fair value gap and respect it. And when price respect this fair value gap and I see a closure below, I can take my entry from there. As you can see here, price move to that fair value gap. You can see price respected this inverse fair value gap. It respected this candle. So you see this bullish candle. We see another bullish candle that appears but closes inside the range of the previous candle. When it closes inside the range of the previous candle, we see another bearish candle that was printed. And when we see this bearish candle, this is where I'll make my entry. If I should place my entry here, I'll have my stop just a little bit above here. Then I will target, my first target will be here. I normally take trades that give me at least 1:2R. Yeah, this one is good. So let's see what price does. As you can see, price comes to this point. When price closes below this candle here, this range here, this is a confirmation on change instead of delivery. We can wait for price to come back and retrace and possibly look for entry in this zone. Inside this zone, this is a fair value gap here, a small fair value gap here. This is our other block, and this is a very fair value gap. If price should come and respect this, then we'll have take our entry from here, and you target this next draw on liquidity here. So as you can see, price hit our targets from here. It is very good to have a target that is reachable. This is not one of the best trades. So this is how you can use change instead of delivery with other combinations of other things in order to take your trade. We are looking for price to still go down further based on our draw on liquidity, but you shouldn't trade that way. You should always target your closest draw on liquidity, which is on a lower time frame. Then possibly you can frame another entry from there. based on what is happening in the market. You always, and another thing is when you are looking for fair value gap, always watch for fair value gaps that are respected and the ones that are disrespected. That is what will give you a directional bias on where to trade in the market. Draw on your liquidity is very, very good, but it is not enough. You still have to determine whether that your draw on liquidity is valid or not valid, again based on the fair value gap, the ones that are respected and the ones that are disrespected. If a bullish fair value gap is being disrespected and price returns and use that fair value gap as a support, then I'll be looking for a bearish trend. If a bearish fair value gap is disrespected and price returns and uses that bearish fair value gap as a resistance, then I will be looking to be bullish. So that is how I analyze my market, and that is what we are looking at here is a probably market maker model that is playing out. It's a market maker model that is playing out. As you can see, we are still in our bigger time frame area of interest. Price can still go up higher to this point, or it can still drop, but we have to look for some other confirmations to take this trade. Assuming I'm looking for another position to trade from here, I've achieved my first target here. My first trade has been made. I have to, price has come here and taken this liquidity, and as you know, when price take liquidity, it seeks another liquidity possibly on the opposite direction. And where is the next liquidity zone? The next liquidity is here. You have liquidity here. We have liquidity here. As you can, there is no fair value gaps here, but we have liquidity areas here. I'll possibly be looking for my entry, maybe if price should come and take this liquidity here and show me that bullish fair value gaps that formed during that process has been been disrespected. So let's just take a look at what price does after this. As you can see here, let's assume that we have this fair value gap here and price disrespect this fair value gap here. Price came, couldn't take this liquidity here, but took this one in a range. We have a range here and we'll have a manipulation leg from here, but price failed to take this liquidity here and created another failure swing. When price created another failure swing here, when you look at this zone, what do you see here? There is no liquidity, enough liquidity that is residing here. There is no enough liquidity that is residing here. We have this area, this price leg is a high resistant liquidity. Why I say it's a high resistant liquidity? Yes, because it took liquidity, took recent liquidity from here, and in this area we have no recent liquidity points. Price always tends to gravitate to an area of lower resistant liquidity, especially when you have almost relatively equal highs or equal lows. In this area here, here is a relative equal high, here is a relative equal high, and we still have this level here. So I'm not so sure of what price, if this price will still go on to see this liquidity here, because this is the only liquidity that is residing here. So I'm expecting price to push upwards I'm expecting price to push upwards, but nevertheless, let's see if this fair value gap here will be respected or will be disrespected. As you can see, price comes into that fair value gap and we see that fair value gap being disrespected. We are expecting price to come to this area and serve as an inverse fair value gap. But when price came to that area, it pushed past that fair value gap. It pushed past that fair value gap. This is a signal that potentially price is chasing these areas of liquidity. Price is targeting these closed areas of liquidity. And what we see price here is price generated liquidity here. We will likely see price generating liquidity here. When price must have generated enough liquidity, then it will come back and take that liquidity, because liquidity is the engine room of price movement. Liquidity is what drives the price. If you are able to pinpoint those areas where enough liquidity is residing, then that is where price is likely to go next. That is why market maker model, understanding the concept of market maker model, will help you spot those areas. So let's see what happens if price comes and take all this liquidity. As you can see here, price came and run this liquidity here. Price came and run all this liquidity, and we have areas of low resistance liquidity here. We have areas of low resistance liquidity here. Can this be our entry zone? Price has taken this liquidity and we have enough low resistance liquidity that are generated here. We have liquidity here, we have liquidity here, we have liquidity here. So can this possibly be our entry level, possibly price pushing down to this area? So let's find out. We have fair value gap here. As we can see, price have disrespected this fair value gap here. We still have this fair value gap here, but it's a small fair value gap. I'm not going to take it. I'll prefer this fair value gap here. So let's see what price does. Where price has disrespected this fair value gap, but we are looking for price to enter into this range, inside this area, then we'll possibly take my entry. But I don't like seeing price move up to close above that target, that area. When price returns and closes above that fair value gap, it is not a clear signal for me to trade. So I normally stay out of that. I would then look for price to possibly come to this range, then take this range. If price should come and take this range, then I'll re-enter from that zone, but I cannot enter trades from here. So let's see how price does that. So we have price run to this point. As you can see, this market was valid, but I don't trade based on that. But we still have price return to this bearish fair value gap here and took that trade. We still have price come down and break this range. So if I should look for my entry, I'll possibly have to wait either to see a bullish fair value gap being disrespected. But we have a very fair value gap here, a tiny one. Yeah. So when price comes to this point, you can still take your trade, but that is not my pattern of entry. I normally trade based on the inverse fair value gap. At least it gives me a higher probability of trade, because price can come here, mitigate this fair value gap, and run to take all this liquidity here, and run to take all this liquidity here. Remember, we have price taking your first liquidity zone here, taking the first liquidity here. So this is a red flag for me to trade on. This is a red flag for me to trade. Price can come here, take this liquidity, push down, or price can come here, enter this zone and zoom off. But if I'm trading here, I would like to see bullish fair value gap disrespected, then I can take the trade from there and target possibly this low here. As you can see, price came to that fair value gap, failed to respect it, and we see price come and took this level here, and we are seeing a bullish fair value gap getting disrespected. This is where I become interested in the price. So let me wait to see if this trade will go. As you can see, price came into that place but run through that fair value gap. Price came and ran through that fair value gap. This might be an entry for some traders, but I like to trade when everything is clear and obvious to me. If they are not clear and obvious to me, I won't take that trade. I would have taken this trade from this area, but the closure of this bullish candle was a red flag for me, so that is why I did not participate in that trade. But price moved to the areas I anticipated but did not go far, and we have price come back and take this point. Like here, I anticipated price to come back to this fair value gap and take down here, but as you can see, that did not happen. One of the reasons why all this thing happen is that you have to always check your liquidity. You have to always check your liquidity. Price came to this point. When price came to this point, price was generating liquidity. We have liquidity here, we have liquidity here, and price generated liquidity here. All these areas are closed liquidity ranges where price is likely to run, and we can see that price ran through this liquidity area. When price ran all these liquidity areas, the next target was this range. You can see price came to this point and took all this liquidity here. When price took liquidity here, price moved up to this point. So we see price take this point, and possibly we are waiting for price to reverse from any points from here. So this is how you can use your change instead of delivery alongside with other concepts to make your entry. So when making your entry, always be patient. Patience is very, very important in trade. You just don't trade because you see a setup. Always wait for a clear setup to happen before you enter a trade. You can miss many opportunities. You can miss some trades. Some trade will go your way, but always wait for that your setup to happen before you make your entry. Sometimes if you may enter a bad trade and that bad trade go in your favor, that doesn't mean you did a quality trade, because when you keep doing that and doing that, in most cases, you will end up blowing all your accounts. So always focus on high quality trade, the ones that give you a higher probability. So that is where you will make your money. A must that you must trade every single day. Always trade when everything in your strategy aligns perfectly together. Even if you take a loss from that trade, but those things must align before you take your trade. Do not say, well, let me take this trade. It did not align, but let me take this trade. No, don't do that. But always trade when everything align. If possible, when building your strategy, have it, make a list of it, have A, B, C. A will be your highest probability. B will be when such a thing happens, you will enter a trade. Maybe this thing did not meet up, you enter a trade. But on that B note, you have to lower your risk. Then on C, the same thing, you have to at least lower your risk. So that is how you'll be profitable as a trader.